Good day, ladies and gentlemen. Thank you for standing by, and welcome to the Niu Technologies Q3 2020 earnings conference call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session, and instructions will follow at that time. As a reminder, we are recording today's call. If you have any objections, you may disconnect at this time. Now, I will turn the call over to Mr. Jason Young, Investor Relations Manager of Niu Technologies. Mr. Young, please go ahead.
Thank you, operator. Hello, everyone. Welcome to today's conference call to discuss Niu Technologies results for Q3 2020. The earnings press release, corporate presentation, and financial spreadsheets have been posted on the Niu Investor Relations website. This call is being webcast from company's our website, and the replay of the call will be available soon. Please note today's discussion will contain forward-looking statements made under the Safe Harbor provisions of the United States Private Securities Litigation Reform Act of 1995. Forward-looking statements involve risks, uncertainties, assumptions, and other factors. The company's actual results may be materially different from those expressed today. Further information regarding the risk factors is included in the company's public filings with the Securities and Exchange Commission. The company does not assume any obligation to update any forward-looking statement, except as required by law. Our earnings press release and this call include discussion of certain non-GAAP financial matters. The press release contains a definition of non-GAAP financial matters and a reconciliation of GAAP to non-GAAP financial results. On the call with me today are our CEO, Dr. Yan Li, and our CFO, Mr. Hardy Zhang. Now, let me turn the call over to Yan.
Thanks, Jason, and thanks everyone for joining us on the call today. We have had a strong growth in Q3 with our total sales volume reaching 251,000 units, a 67.9% year-over-year increase. The sales volume in the China market reached 245,000 units, a 70% year-over-year increase, where the volume in the international market reached 5,600 units, a 6.3% year-over-year increase. Now, in the first 3 quarters, our sales volume reached 451,000 units, an increase of 43% compared with last year. Now, our strong growth in China was driven both by the market factor and our operation performance in the new product rollout, marketing, and channel expansions. Now, first, let me quickly comment on the overall market landscape in China. Now, the overall electric bicycle market has increased by 30% to 22 million units in the first 9 months, according to the Ministry of Industry and Information Technology. This increase was driven by 3 factors. First, the post-COVID-19 sentiment led to a high demand of individual mobility devices as more people find electric bicycle a more convenient, safer means for the daily commute. Now, second, with the adoption of 2019 China electric bicycle standard, more cities started to regulate this industry with license plates, removal of uncompliant products, and such created a safer environment for the users. And lastly, with the lithium-ion battery costs continue to decline, the electric bicycle with portable lithium-ion batteries become more affordable. It was estimated that 20 to 30% electric bicycles this year are lithium versus 10 to 15% in 2019. Now, amid the fast growth of electric bicycle market, and particularly the lithium-ion based ones, we also accelerate our effort in new product rollout, marketing, and channel expansions. As we mentioned in the last earnings call, we introduced the M2 model in Q2 and the MS model in July. Both M2 and MS inherited the family design of our signature M product, viewed as a full-cover electric bicycle. In Q3, M2 and MS series accounted for 18% of our total sales volume. Meanwhile, we also enriched the GOA series family with our G0, G2, and upgraded G3 series. G0, an entry-level product, was launched at the JD June 18 campaign. With G0, G1, G2, G3, the GOA series now serves the full range of customers' needs from electric bicycle to electric motorcycles in China, with prices starting at 22.99 RMB. The entire GOA series sales accounted for 37% of our total sales volume in Q3. Now, the successful launch of M and G series continues to demonstrate our strong capability in product design and rollout. Furthermore, with G series entry price at 2299 RMB, it allowed us to cover the mid-end consumer segment and open up more markets in the lower tier cities, which accounted for more than 70% of electric bicycle market. Now, supported by the newly introduced product, we continue to expand our footprint throughout store expansions and new market entries. Now, in Q3, we increased our dedicated branded store to 1,266 stores, an increase close to 200 stores as compared with Q2. This quarterly new store add was an all-time high as we significantly increased our effort in retail expansion. Now, despite the fast increase of number of stores, our per store sales also increased by 40 to 50% in Q3 year-over-year compared with the same time last year. This demonstrates the healthiness of our retail operation as all the retail stores enjoy a sales growth and were highly profitable. This is also a good indicator for future retail expansion. We are accelerating new store openings in Q4 this year as well as in 2021. Furthermore, with the GOVA series, we were not only able to consolidate our leadership position in top tier cities, but also able to build a good retail presence in the lower tier cities. To support retail expansion, we also scale up our marketing activities in Q3. On the mass media front, we kicked off a Back to the Street, This is New campaign and partnered with the hottest online competition show called Street Dance of China in Q3. This campaign was a coordinated effort of advertising in the online show with more than 200 million views, interaction with all social media channels like Douyin, Kuaishou, WeChat, and Weibo, and offline advertising in subways and buses. It generated a total of 800 million brand exposures and continued to enhance our brand image as a cool lifestyle brand. We also continue to build our brand image with co-branding efforts. This time, we worked with the Gundam, a popular Japanese cartoon in China, and rolled out a Gundam special edition based on our MS product. This co-branding has received quite a bit of market hype with close to 50 million views of new Gundam content across multiple channels. Now let me turn over to the overseas market. Our overseas market reached to 5,600 units, a small growth of 6.3% year-over-year. Well, in fact, we had about another 1,000 orders in Q3 not able to ship in time due to the scarcity of international shipping. Now, even without this delayed 1,000 orders, this demonstrates a swing back to normality in the overseas market as our Q2 sales overseas were actually down by 62% year-over-year. This is only the start as most of the people in our core demographics are working from home. So as more individuals goes back to work, we will continue to see growth across our markets for individual mobility. In Q3, we will also increase our flagship and premium stores to 114 from 91 in Q2. And year to date, we have added 88 flagship premium stores, with now more than 40% of our sales from branded flagships and premium stores. Similar to China market, we will continue to expand our retail footprint with branded flagship and premium stores for Q4 and 2021. Along with our retail expansion, we have also upped our effort in the social media with close to 800,000 interactions on Instagram and Facebook. Now, while we are watching closely the COVID-19 situation globally, we're quite confident that our international sales will return to the healthy growth in Q4 this year. Now I will turn the call over to Hardy to discuss our financial results. Hardy.
Thank you, Yan, and hello everyone. Our press release contains all the figures and comparisons you need. We have also uploaded Excel format figures to our IR website for easy reference. As I review our financial performance, we are referring to the third quarter figures unless I say otherwise. And that's all monetary figures RMB unless otherwise noted. Our Q3 sales volume reached 251,000 units, increased by 68% year-over-year. China sales volume increased by 70% as a result of retail sales network expansion and new product launch. International sales volume increased by 6%, lower than our expectation, mainly due to rebound of COVID-19 and the difficulty to book containers for international shipping. We expect some of these challenges continue into the fourth quarter. We are currently working on different initiatives in order to deliver continued growth from international markets. Regarding product mix, as we launched a few new products, the mix changed accordingly. N-series accounted for 12% of total volume. M-series accounted for 23%. U-series accounted for 28%, and the GOVA series accounted for 37%. Out of the 37% from GOVA series, 27% is from the mid-end product G0 model, and the remaining 10% from G2 and other GOVA models. The high percentage of G0 sales volume had a negative impact on our Q3 ASP and gross margin. Total revenues increased by 37% to 894 million, in line with the guidance we provided earlier. The increase was driven by higher sales volume growth of 68%, partially offset by decreased revenue per scooter, or ASP, of 19%. There are a few key drivers for the ASP decline. First, sales of low-price model G0 negatively affected ASP by around 11%. Second, the change in product mix in other models, especially lower percentage of sales from the high-price N-series products, negatively affect the ASP by around 4%. Third, the sales and promotion with direct discounts to end customers affected our margin by around 1%. The remaining 3% decrease is mainly due to relatively slower growth in spare part sales from overseas operating or sharing operators due to the impact from COVID-19. We expect some of these drivers continue into the fourth quarter. Therefore, the ASP, when comparing with Q4 last year, expected to decrease by similar percentage. Gross margin was 20.9%, 1.3 percentage points lower than this time last year. The lower gross margin was mainly due to a few factors. First, the sales promotion and discounts we offered to end customers affect the margin by 0.7%. Because we offer the sales discounts to end customers, we are able to save on marketing and sales expense. As percentage of revenue, our sales and marketing expense reduced by 3%. Second, we disposed discontinued products. The disposal price was below cost and hence negatively affect our margin by around 0.9%. Third, higher sales volume from mid-end product G0, which has lower gross margin. The impact is around 4%. However, we are able to offset such negative impacts from G0 by cost savings on battery packs and various components. Overall speaking, the margin for the products are relatively stable compared with both last quarter and last year. The decline in gross margin in Q3 was mainly caused by sales discount and disposal with total impact 1.6%, which are both specific to this quarter. Our total operating expense, excluding share-based compensation, were 97 million, increased by 16 million or 20% year over year. The increase was mainly caused by the higher R&D expense of 10 million for staff costs and design expense. Higher G&A expense of 14 million, mainly related to foreign exchange loss, tax and surcharge, and professional fees. Sales and marketing expense, however, decreased by 8 million. As I mentioned earlier, we offered a sales discount to end consumers, which affected our revenue and margin by 0.7%. We then able to reduce our marketing expenditures. As a percentage of revenue, the sales and marketing expense, excluding share-based compensation, was 5.4% compared with 8.5% in Q3 last year. Our government grants were 1.1 million in this quarter, significantly lower than the 12.6 million in Q3 last year. The company is eligible for additional government grants. We have applied for RMB 10 million government grants, but the payment from government was delayed. We will book government grants into our income statement only after we receive it in cash. Our share-based compensation expense were RMB 10.6 million, almost the same as what we had in the second quarter. Compared with Q3 last year, it is an increase of 4.5 million due to the new grants to employees in early quarters. Our GAAP net income was 80 million, and adjusted net income was 91 million, an increase of 25% year over year. The adjusted net income margin was 10.1%, 1 percentage point lower than Q3 last year. The 1% decrease was caused by a few factors. Our gross margin was 1.3% lower, but it was offset by higher operating leverage, which is 1.6%. We had a lower government grant, which negatively affected our net margin by 1.8%. If we exclude the negative impact from government grants, our adjusted net income margin has actually improved against the last year. Turning to our balance sheet and cash flow, we ended the quarter with RMB 1.3 billion in cash, term deposit, and short-term investment, an improvement of 300 million compared with last quarter. Our operating cash flow was around 300 million because of improved profitability, reduced account receivable, reduced the inventory, and increased account payable. Our capital expenditure was around 30 million, mainly related to new store openings in China and international markets, additional machinery, and R&D spending. We had a healthy balance sheet and a very strong cash flow in the third quarter. Now let's turn to guidance. We expect fourth quarter revenues to be in the range of 555 to 615 million, an increase of 5% to 15% year over year. We expect continued sales volume growth from both China and overseas market. The ASP will decrease year over year due to the change in product mix, similar to what we saw in the second and the third quarter. In addition, in Q4 last year, we had strong sales in accessory and spare parts to sharing operators from overseas market. We do not expect such high sales in this quarter. Throughout this year, our orders from sharing operators has reduced significantly as a result of COVID-19. The revenue and ASP for sharing operators are usually much higher than other orders because they order not only scooters but also manufacture spare parts. In the fourth quarter, we will continue expanding our retail sales network in China. We expect to open more new stores at faster speed than what we did in Q3. We are also working on the construction of our new manufacturing facilities in Changzhou. This will better prepare us for continued growth in 2021. Our overseas market began to recover. We had a very strong order book for Q4, which is a good sign for demand recovery. With that, let's now open the call for any questions that you may have for us. Operator, please go ahead.
Certainly. Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question, you may press star 1 on your telephone and wait for name to be announced. To cancel the request, you may press the pound or hash key. Once again, to ask a question, please press star 1 on your telephone. We do have a first question from the line of Roger Duan. Please go ahead.
Hi, management. Thank you for taking my question. I have 3 questions. First is there are several international countries in which we have local dealerships have re-entered the lockdown. Can management share the magnitude of negative impact we can expect from these international markets for 4Q and potentially first quarter 2021? And my second question is somewhat tied to the first one. How should we think about the ASP will trend for 4Q and 2021 given international markets continue to experience pressure and the lower price G-series products continue to grow as a percentage of units sold? And my third question is with regard to the competition. Can management share any insights on how we're thinking about competitions with industry leaders? In the past, we have largely avoided competing directly with them by offering products in different price categories. But it has somewhat changed after our launch of G-series. What is our strategy to continue to take market share from these legacy scooter makers? Thank you.
All right, thank you. I think those are great questions. I'll try to cover this again. So I'll try to cover questions 1 and 3, and then I'll have Hardy to cover 2 on the ASP front. So I think on the international market, yes, I think our Q2 was our worst case where we actually see a decline of 60+% in Q2 because a lot of stores closed. In April, May-ish, all the stores are closed, and then that gave little confidence to our distributors in terms of ordering. Because you have to keep in mind that a lot of the the Q2 sales, the quarterly sales we see on the international, usually there's like, that's actually the time we ship the product. So in terms of retail, it's basically like a quarter after. Now, what happened in Q2 is most of the stores are closed, and that forced our distributors to actually not order anything. That's why we start seeing a huge decline. But starting in May, stores start to open, and then that gives distributors a bit confidence. So we're seeing uptake orders in Q3. That's why we're seeing up to about 6%. But in reality, I think we should have seen more because we had like 1,000 order of scooters not able to out the door because there's really a scarcity of international shipping with containers. We are actually quite confident with our Q4 as, from order book point of view, a lot of orders are coming in. We expect, a really healthy growth for Q4. Now the issue is booking the international shipping containers. This international shipping, actually, the containers at this point seems to be a scarce resource as a lot of ports in Europe, there are not enough people working on the ports. But from order perspective, we're actually seeing a huge, order take up in Q4 for the international market. I think this is on the 2C side. Now a little bit on the 2B side. On the 2B side, we're not seeing a great year this year. By 2B, most of our orders are for the sharing operators. Sharing operators this year haven't really been doing well this year because, with the COVID-19 situation, with people working from home, you're not seeing a pickup in the sharing operators as opposed to last year where we see a lot of sharing operators order of scooters, both from the United States and from Europe. We are seeing some this year, but the order has been slow. So, but on this one, we're hoping that with Q4 and the next basically Q1 in 2021, where the sharing operators, the orders from sharing operators will come in. Because I think we're already seeing a recovery, like for example, Rebel from the United States, they're already seeing a recovery in terms of more the riderships in the United States. So I think for the 2B side, we're seeing probably a little bit Q4, but most likely Q1 next year, Q1, Q2 next year, where we're going to see quite a bit uptake on the international market. Now, lastly is actually where we are, as we put on the press release, we are basically starting a pre-sales marketing campaign for the Indonesian market. This will be sort of our official entry to the Indonesian market. The actual sales or the revenue we won't see that revenue in this year because the pre-sales will happen in December, but most order fulfillment will be in February and March-ish. But that will add a healthy growth in Q1 2021 and potentially the entire 2021 as we're basically this mark as our first step to enter the Indonesian market of Southeast Asia, the major country in Southeast Asia. So hopefully that addressed your the question number one. I think just lastly, I think on I'll address question number 3, then I'll give to Hardy to add on question number 2. I think yes, with completions we are with the Goer series, we are entering into the mid-end market segment, or mid to high. I think it's more or less mid to high market segment, where I think the traditional players like other brands have presence in that market. But so far we have seen that our Goer series has been able to achieve quite promising results. With the entry price at $22.99, I think we have product range from $22.99 up to 4,000 RMB. And the Goer series in Q3 actually accounts for about like 37% of our sales. And it basically demonstrates, and we are able to, when we compete with traditional brands in that market range, used to be we're the only one sitting on the high end, but now we come to the mid-end with the mid-end product, still with a good-looking design and also a great riding experience in terms of the product experience. We are able to gain market share from the traditional players. And now the issue is we are not. This really marks the beginning of this journey. Where you look at Q3, we added about 200 stores. So even with additional 200 store adds, our per store sales actually went up by 40%. This is particularly because with this mid-end product, the stores are able to use this product to gain market share from competitors. And this also allows us to open more stores in our stronger cities like Tier 1 cities, Tier 2 cities, where we're able to approach, basically target the mid-end market consumers in that cities, as well as allow us to open more stores in the lower tier cities where we used to have little presence or zero presence. And so with that, I think that's where we actually have more confidence looking at we're going to accelerate the store opening effort. 200 store openings in one quarter has marked an all-time high, but I think that's a historical all-time high, and we'll continue to beat our record in terms of store openings. Now I'll pass to Hardy to address the pricing part.
Yes, for the ASP, as you already see in the third quarter numbers, the ASP in the third quarter was down by 19% year over year. In the fourth quarter, in short, we expect the ASP will, compare with Q4 last year, will decline at a similar percentage. However, we encourage you to look at the ASP by product segment. So the ASP for China scooter sales, ASP for international market, and the ASP for accessory and spare parts. If you break them down, then they tell you a different story. For the ASP for China market, if you look at the third quarter, the price was down by around 18%. Out of that 18%, around 13% was affected by higher percentage of sales coming from G0. Last year, there's no medium product G0. This year, G0 takes around 27% of total sales volume. That affected China ASP by around 13%. The remaining 5% came from the changing product mix from other models, especially we have a lower sales in the N-series products. If you look at this trend in China going forward, the G0 model will continue to be there. However, we do expect in the other models we will see some improvement. Therefore, the ASP for the China market, if you compare year over year, we will have some improvement in the fourth quarter. Then we look at ASP for international market. If you look at the year over year change, actually in this quarter, our ASP for international market increased by 27%. Quite a significant improvement, mainly because there's small sales volume, therefore there's big change in the ASP. For the international market, our ASP is relatively stable. It's always anywhere between around 9,000 to 10,000 RMB. So for international market, we do see quite a stable, relatively stable pricing. Then lastly, on the ASP for accessory and spare parts services, this one for the China market, the price was relatively stable. However, for the overseas market, it was significantly affected by how much spare parts we can sell to the sharing operators. As mentioned in the call, this year we do not have as much as orders from sharing operators in Q3 and expecting in Q4. Therefore, we do see some pressure for this ASP going down. However, for next year, with the recovery from the international market, we do begin to see some of the new orders coming in for both the sharing operators and also for both the sharing scooters and also for the sharing spare parts. So for this part, we do see pressure in the Q4, but next year we do see some potential for improvement. So in short, I think if you compare year over year in the fourth quarter, the ASP will decline a similar percentage. But if you compare quarter to quarter, we do expect the fourth quarter ASP will improve compared with third quarter. If you look at next year, and I believe the Q3 and Q4 ASP will be a quite good proxy for us to estimate how much we will have for next year. So this answer you in the second question.
Oh, thank you so much. Very clear.
Thank you. We have our next question coming from the line of Alex Potter from Piper Sandler. Please go ahead.
Great. Thank you, guys. I guess my first question is regarding capacity in Changzhou. You mentioned you're still in the process of expanding the capacity there. What's the update? How much is left to spend in terms of CapEx, and what is your annual capacity now versus what it will be next year?
Yes, Alex, let me address for your question. Currently, our design capacity around 1 million units, and the new capacity, the new factory has another 1 million capacity, and we plan to bring the new capacity on board sometime during the second quarter next year, because from the second quarter the peak season started. The total capex for this new capacity will be anywhere between 100 million to 120 million, including land. We started construction in October, and it may take us around 5 to 6 months to complete the full construction. So I hope this answers your question.
Okay. Yes. Thanks very much. Was wondering if you could talk a little bit about the promotions and some of the price discounting you talked about also in the quarter, which was an impact on gross margin and ASP. What products were you promoting specifically? What promotions were you running, and how long do you expect to keep doing that?
Yeah, I think a very good question. I think for Q3 we have a different format of promotion this year compared with both early years and also from last quarter. Is we give cash coupon to our end customers, and they can use this cash coupon to deduct the sales price. And therefore, we spend around 8 million RMB for this promotion. This is direct deduction from our revenue and also our gross margin. And we have this kind of promotion mainly because this Q3, because of the COVID-19, people are more sensitive for price. Therefore, we believe give a direct discount to end consumers is better than we spend money in different ways. However, from Q4 this year, we have no such promotion plans. Therefore, we more attribute to this kind of promotion as one-off promotion in the third quarter.
Okay, and was this specific for any certain types of products, or was it broad?
No, it's broad. So basically, the consumer go to the store, then they pick the model that they like, then they go to a lottery system. And if everyone will win, will get something. So someone gets 100 cash coupon and a direct deduction for their sales price. Someone can get up to 1,000 cash coupon, which can be deducted directly from the sales price.
Okay.
So it's cross different models.
Okay. And then the last question from me is on the regulatory change. Can you remind us when exactly the new regulation will be enforced? And it sounds like you do think that you're getting some demand, because I know people are obviously going to be forced by the new regulation to replace their scooters. Do you think that people are doing that now? When do you expect the most of that demand to materialize?
No, I think, Alex, it depends on city by city. First of all, the new regulation, basically the temporary new regulation was announced in 2018. It started to enforce on April 15, 2019, and different cities actually give different year. For example, city of Beijing, they gave temporary license plate in 2018, and they said it will basically, the temporary license plate you can use the scooter for 3 years, which essentially means some of the scooters will be out of street by end of 2021 or or I think early 2022. So which we'll expect to see what they call the replacement on compliant temporary license scooters starting next year. So I think this is also an indicator. I think this is actually a driver for us to quickly expand, add more stores in those cities or in highly regulated cities. And the good thing for us is actually our market share and our presence is actually much stronger in the highly regulated cities, because most of the highly regulated cities are the tier 1, tier 2 cities. Where in the tier 3, tier 4 cities, I think the regulations still being enforced some places very loosely, where you won't see this uptake in tomorrow replacement yet.
Okay, great. Thanks very much, guys.
Thank you. We have our next question coming from the line of Bin Wang from Credit Suisse. Please go ahead.
Okay, thank you. I actually also got one. The first one is about a very top-down angle about the overall market, because if you see the number from MIT in the number 3 quarter, the overall production in China increased by 61% year over year. And for you, actually outperform, yes. But if you really excluding the G series, actually in the high end is only around 11% growth. So can I make sure the conclusion is that in the high end market actually is much slowing down, and the MIA is the key driver? Can I have that conclusion? Meanwhile, actually, because regulation is that means regulation really just have some impact on the high end, and the low end simply people don't care. So how to elaborate? How to understand the different segments have a quite big difference growth. That's number one. And number two is about the guidance. Basically, can you explain why the October sales number is so bad, and why a huge rebound in the growth in the November and December? So based on your guidance in the revenue, we cannot really get a number, say 150,000. That is a guess. So it means the November and December have more than 50% growth. So can you elaborate whether my calculation is correct or not about the November, December growth? If it was correct, why the reason have such high growth after a big dip in the October? Meanwhile, what's the guidance for next year, 2021, based on the November and December momentum? The second one. And third one is about the new products and new store, because if you see in the past 1 year, you have been launched quite a few showcase called MRI and RRI, but it doesn't seem this new products really bring any volume. So can I know, number one, when will be next products, volume products, and why this new product didn't really bring in volume? So how we should think about your new products plan for the coming years? Meanwhile, what's your store guidance for next year, or maybe end of this year and next year? Thank you.
I think your first question is about the volume growth. I think if you look at the information published by the Minister of Information Industry and Technology, their Q3 electric bicycle volume growth is anywhere between 40% to 50%, depends on which month you are talking about. Our growth definitely is much higher. We are growing about 70%. You are also correct that the G0 is the key driver for us to grow in China, and our high-end, the NMU series, has a growth around 11%. I think one of the key reasons is after the new regulation was enforced, the new regulation says the top speed also gives some weight limit to the electric bicycles. Therefore, a lot of the functions also, including driving range, including other functions, we were not able to add to this electric bicycles. Because of that, definitely customers do not want to pay high price for the extremely high price models. I think that's one of the key reasons why the high price models have a slower growth rate compared with the low end models in the electric bicycle category. And for your second question about the sales volume in October, November, and December, I think your calculation roughly okay. I think in October, as we already mentioned in our earnings release, it's partially because of the operational disruption in our factory, because in September we used up to the have a full usage of our utilization of our factory because of the huge demand in the third quarter. Therefore, we have to make some maintenance for our machinery, for our factory, to make sure we have a safe environment to prepare for November and December. Because of that reason, some of the sales volume shift to November and also December. This is one reason. That's why you see the higher volume in November and December. Second reason, as we already mentioned, and we continue to open new stores in China, as we already see there's more places for us to open new stores as we launch the G0 model, the mid-end model. Also, we have opened more. We have accelerated the opening process. This will also help us to increase our sales volume in both November and December. So I think this is a few drivers to continue the sales volume growth in November and December. For next year's guidance, we are making this in early next year. So we won't mention it during this call. In terms of new product launch, I think I will comment a few words, and I will leave to Yan to comment on next year's plan. For the new products, the TQI, RQI, and also the EUB products we launched in early this year, they have not entered into mass production yet. Therefore, they are not the one who drive our volume growth for this year. The reason is the TQI, RQI, and EUV, they are mainly targeted for overseas markets. Their sales price also much higher. This year, because of COVID-19, the overseas market, for different reasons, we are not able to achieve very high volume growth. Therefore, we postponed the mass production of some of the models for TQI, RQI, and EUV. For next year, we do plan to launch additional models for the China market, and the new products will launch sometime during the second quarter. We believe some of the new models we launched in China will be hit products and continue to drive our volume growth in China. For the overseas market, what we are doing is we began to use our global series products to enter into the Southeast Asia market, especially Indonesia market. So already in December this year, we are going to launch one of the global motorcycle models in Indonesia market, and we began to pre-sale in the middle of December. We believe that will help us to drive the volume growth in Southeast Asia market. So this is some of the comments on the new product launch and how they can drive our volume growth in next year. Yeah, I think this is the answer to your question from me.
Okay, thank you.
Thank you. We have our next question from the line of Jing Zhang from CICC. Please go ahead.
Thank you for taking my question. Basically, I have two questions. The first one is about the store and channel expansion. So what's our target next year for store expansion? And we see other competitors opening stores at higher speed. So I want to know what are our major concerns or difficulties in terms of opening stores. And my second question is, we are going to sell e-motorcycles in Indonesia. So can you share some details on our strategy in terms of production? So whether we export or build the factories there, and our channels, and also our product compared to the local brands motorcycles, and also maybe a long-term sales target. Thank you.
Yeah. No, I think great questions. The first one on the store openings. So as I mentioned earlier, so in Q3 we're able to add about 200 stores, and so keep in mind Q3 usually has been our busy sales quarter, where our distributors are not willing to open stores. But this year, actually, with the effort, we actually have a capability to open 200 stores in one quarter, and now we're actually thinking about after that game in Q4, opening more stores than Q3, and we actually have a higher ambition for next year. So we don't, it depends. I guess it really depends on how we wrap up the Q4 this year. We'll have a more relative goal for next year. So I think that's basically on the store expansion. And more importantly, if you look at the data here, it's actually we have the capability to open faster more, because even with the Q3 with the 200 store ads, our per store sales still went up by 40%. So that means there's actually a lot of room to open new stores at this point. So you can easily see we can actually get to 200 or 300, even 400 stores in Q4, and we'll see how that depends on how fast this construction can be finished. And that will actually serve the guidance for next year as well on a quarterly basis. Now, with the Indonesian market, I think it's yes, one, we will have to initially will be local. It will be on a sort of a CKD method, because Indonesia has a huge tariff. If you ship the entire product from China, I think the tariff is about 40%, so that will make the pricing not relevant. We want to actually enter the Indonesian market. We have a high-end product, but we want to enter sort of a mass, affordable product level, affordable price range product. So which actually will ensure we're not being viewed as a luxury product, but more a mass daily commute product. So this will actually right now we have a basically manufacturing partner in Indonesia will help us to assemble the product, even with some of the parts being locally sourced, and that will actually get to a lower tariff, usually about like less than 8 to 10%, because it's mostly on parts, and that's probably will happen for next year. In the later half of next year, we'll see, depending on how the sales volume goes. We might have to actually invest to build a factory in Indonesia. Hopefully that answered your questions.
Thank you. That's all for my questions. Yeah.
Thank you. Once again, ladies and gentlemen, to ask a question, please press star 1 on your telephone. We have our next question coming from the line of Sebastian Van Heren. Please go ahead.
Hi, good evening. With the upcoming importance of the GOVA series, to what extent do you intend to use after sales to protect your margin? Thank you.
I think even with GOVA series, I think the after sales will be still conducted by our branded retail stores. From using after sales to protect margin, I think it's a similar method as in with other series. I think the question, we look at the actual margin of the GOVA series, it's actually slightly less than our Niu series, but not significantly less. It's probably just a couple percentage less. Because even though it's actually marked at the lower prices, because it's using the battery uses it's not NCM or NCA batteries. It's actually used LFP batteries, which actually it's an alternative, but it's actually cheaper than the NCM and NCA batteries. And the lower end of GOVA series doesn't have the smart IoT. The smart IoT is the add-on. So for people who actually take a series as a basic level, it doesn't have the smart IoT, so that actually helps to reduce the cost and reduce the price set as well. But our app does support a product where the users can actually, with or without IoT, the user can download the app and then actually register the scooter on the app and then be able to receive the same level of after-sales services on the app as well.
Okay, thank you.
Thank you. We have our next question from the line of Paul Gong from UBS. Please go ahead.
Yeah, hi. Thanks for taking my question. I have only one question. You mentioned the tariff between the Indonesia market is 40%. So that's why you decided to build a factory over there. So in view of the ECLP, and how shall we foresee the tariff going forward? And the local factory, is that still required in your view?
No, I think that's a great question. So I think we are actually looking. We saw the news as well, but we haven't really get sort of the detailed information yet. So if the actual detailed information, basically like electric motorcycles, are actually covered by the treaties, then actually that will solve a lot of our issues as well. Let me put it this way. Frankly, we'd rather have everything manufactured in China, where we have a really tight control with our own factories into our quality insurance, everything, and from management complexity, it's actually much easier to get manufactured in China versus shipping parts to Indonesia and have it locally assembled and manufactured there. We understood why the tariff was there because a lot of motorcycle brands are locally manufactured there. So there's actually sort of a locally protection there in terms of that industry. But if that opened up where the tariff is being reduced significantly, that actually will change our manufacturing planning. That's one of the reasons right now we decide not to, for example, buy a land or build our own factory in Indonesia. We're simply still watching out to see but by using it more flexible, using a partner as assemble option at this point, because that gives us the flexibility, depends on how that how that whole treaty thing goes.
Okay, thank you very much. Very helpful. Thank you.
Yeah.
Thank you. Seeing no more questions in the queue, let me turn the call back to Mr. Li for closing remarks.
Right. So thank you, operator, and thank you all for participating on today's call and for your support. We appreciate your interest and look forward to reporting to you again next quarter on our progress. Thank you.
Thank you all again. This concludes the call. You may now disconnect.